Welcome to Your Success TV. I'm Ken Wells, your host, and today we're going to talk about tax planning for individuals and business owners. And joining me today is Sabina Mexis, who's a lawyer with Devery Smith Frank, LLP, and she's a partner in the tax group and specializes in tax, business succession, and tax planning. So Sabina, welcome to the show.
Thank you. It's a pleasure to be here.
So Sabina, we all want to pay less tax, but at the same time, we really don't want to get into trouble with the CRA. And I guess that all begins with planning. So can you explain to us what is tax planning?
Sure. In its most simplest form, tax planning really is the ordering of your affairs to achieve two objectives. One is to minimize tax during your lifetime, and the other is to minimize the tax that you pay and to have an orderly transfer of your assets on your death. So when we do tax planning for individuals and for business owners, we keep those two objectives in mind. So business owners will plan to minimize their tax during their lifetime with respect to their type of remuneration, and we'll talk to them about business succession planning and whether and how they wish to transfer their business to the next generation.
Okay, so when is tax planning necessary?
Well, tax planning is always necessary because at some point there will be a tax bill. Tax is levied on death on the fair market value of the assets that you own. So if you own any assets at the time of your death and those assets have appreciated in value, there will be tax that will be due and payable at that time. So depending on the size of your estate, the number and types of assets that you own, tax planning would be necessary to deal with the potential tax liability that will arise. But also, and perhaps more importantly, for business owners and for people who have shares of private corporations, tax planning is important for an orderly transition of their assets to the next generation.
Okay, so in regards to taxes on death, right, what can be done to mitigate those taxes?
So there are two types of taxes that we need to think about on death. So the first is income tax. And again, as I indicated, income tax becomes due and payable when a person dies, and is the appreciated value of their assets that they own on death. Tax is calculated on that value and tax becomes payable at that time. There are certain deferrals available. So for example, between husband and wife, there's a deferral of tax. So on death, a husband's assets, if they are to pass to the wife, are not subject to tax. They'll pass tax-free to the next generation or to the spouse. However, on the death of the surviving spouse, those assets will become subject to tax because there are no further rollovers from spouses to children. So that's one issue to think about, is how to transfer assets in advance of the second death. So for example, assets can be sold or gifted when they are perhaps at a depressed value. So if you have an asset that has depreciated in value and disposing of it would give rise to a loss, then that would be a good time to consider conveying that asset either to a child or another family member if that's your wish, or you could transfer it to a corporation and not pay any tax on that asset at the time of transfer. There are tax-deferred transfers that can be done with respect to corporations. So if you wanted to set up an investment holding company, for example, and you wanted to transfer certain assets to that company, the shares of which would be owned by your children, you could engage in tax planning before death to set that sort of structure up. Another great thing to do to minimize tax, income tax, and also probate tax, which is the second one we'll talk about in a moment, is to set up a family trust. Many people think family trusts are just for rich people, and yes, many wealthy people do have family trusts. But a family trust mostly provides for the orderly transfer of assets before death, because if you set up a trust during your lifetime, you transfer the assets to that trust, and then those assets pass outside of your estate. So on your death, there is no tax event because the assets have already been conveyed out. And you've achieved the objective of having those assets go to your intended beneficiaries. The second benefit of setting up a trust is you avoid probate tax. So people have probably heard about probate fees, which is a tax that gets paid. It used to be paid into court. It now gets paid to the CRA. And on death, probate fees are based on the value of your estate. It's possible, and indeed most of the planning that I do that is intended to minimize income tax also has the benefit of also avoiding probate fees. So there's a double benefit there to doing tax planning to avoid both income tax and probate fees.
Okay, so as a business owner, is there things that I can do to reduce the amount of tax that I pay?
So one of the most important things that a business owner can do, if they have an operating business, so let's say they manufacture something or they are engaged in some kind of active business, then the shares of a company that's engaged in an active business are eligible for the lifetime capital gains exemption. So currently that's over $800,000, and that amount is continuing to be indexed annually. So that is a big benefit to small business owners whose shares would qualify for the exemption, because that's $800,000 of capital gains that they will pay no tax on. So it's very important, if there is a business owner that they, and they are eligible for the exemption, that they can plan to multiply the number of exemptions that they can have access to by adding family members as parties to their business. So they can add them either as direct shareholders or through a trust. They can also take steps to reorganize the business. So if the business is engaged in a variety of activities, and some of the activities give rise to passive income, which is quite common. Business owners are very busy. They will have their business, they're focused on running their business, but they invest their surplus assets. What ends up happening is this could throw it offside for the capital gains exemption. So in that case, what people would do is they would engage in a reorganization of their business to strip out the surplus assets and transfer them to a holding company. They could also, so that would achieve the objective of keeping the availability of the capital gains exemption intact, as well as transferring surplus assets out and beyond the reach of creditors, which often business owners tend not to think about what's available for creditors. They're just focused on running their business. The third advantage is that they can succession plan to the next generation at the same time. And the fourth benefit is that if, depending on the value of the business, they can do something called an estate freeze. An estate freeze, as the name implies, fixes the value of a person's interest in a business at a fixed amount. And so if the value of the business grows in subsequent years, that freezor's interest never changes. It will never increase. So an estate freeze combined with a reorganization is a great way for a business owner to quantify the amount of tax that they will eventually have to pay and minimize their tax on an ongoing basis. It's not a simple one-step solution. Often when people come to the stage that they're thinking about tax planning and succession planning, there are multiple considerations. They think about their estate, they think about who's going to take over the business after they're gone, they think about the involvement of their children in the business. So we often do all of these things at the same time, but then all of the affairs are in order and they don't have to worry about things transitioning in a way that they don't anticipate or they don't want.
So what would happen if an individual did nothing, right?
So if an individual did nothing, the primary thing that will happen is that they will pay more tax than they have to. So let's take an example of a person who has no will and they own shares of a private company that has substantial value. So without a will, they will have to apply, they will die intestate, and if they have a spouse, then the assets will all go to the spouse. But in order to convey the assets, they will need to apply to the court for a certificate of appointment on an intestacy. So they'll pay probate fees, and because there is no will, the full amount of all of their assets will be subject to probate fees. Then, because they've done no planning, the full value of any business that they own or any assets they own will become taxable. If they convey them to their spouse, the tax is deferred and there is an opportunity for planning after that. But if there is no spouse, which I find is often the case when the spouse has predeceased or the parties are divorced, then there is no further tax deferral. The tax becomes due and payable when the person dies. So they end up paying, there's more administrative headache as far as having to apply to court. there is more tax payable because they've done no planning, and they may likely lose the capital gains exemption, so they'll end up paying more tax. And often clients say, well, what do I care? I'll be dead. And although I understand why they're asking that question, it really is the wrong question to ask. Because what happens is it erodes the value of their legacy. It erodes the value of all they've worked for their whole lives, with the result that their estate, at least half of their estate, depending on its size, goes to the government.
So aren't tax lawyers expensive?
Well, like any professional services, lawyers in general can be expensive. A tax lawyer is no more expensive than any other lawyer. The issue with hiring a tax lawyer is that the transaction will be done properly. It will be done by a person who only practices in the area of tax law. I have had experience in the past where I've had generalists who have drafted a will or who have tried to do some kind of tax planning, and they don't have in-depth knowledge of the law, the tax law. And so there are errors that have been made. There's a lot of technicalities in the Income Tax Act. As you can imagine, it's a very huge document. And knowing the ins and outs of the Income Tax Act, the potential pitfalls, the potential traps, the worst thing that can happen is someone wants to do their transaction or do their estate planning on the cheap, and then there's been an error and it ends up either in litigation because they have a beneficiary who feels they should be entitled to something that they otherwise aren't under the terms of whatever's been done, or, and this is more usually the case, the transaction hasn't been done properly, and so the entire thing gets unwound. The CRA will come after for unpaid tax, they'll reassess. It ends up being more expensive. Proper planning done right is a good safeguard to ensure that the tax liabilities are known, are quantified, and there aren't going to be any surprises.
Okay, so if I'm behind on my taxes, right? What should I be doing if I'm behind on my taxes right now?
So there's a few things that we can think about if we are behind on taxes. The CRA, so first of all, we are a self-reporting jurisdiction. So what that means is that individuals and corporations, really any taxable entity, is required to report its own income tax. There is no authority that's going around compelling us to make a filing. The CRA may at some point file a demand to file, but for the most part we operate on the premise that we are a self-reporting and self-assessing taxpayer base. So if you don't file, there is an opportunity to come clean under what's called the Voluntary Disclosure Program. So the CRA permits taxpayers who have unreported income, either they haven't filed tax returns or they filed them but they didn't disclose all their income. For example, income from foreign property is something that I've been doing a lot of lately. With changes to foreign reporting forms, all of a sudden people realize they didn't report the farm that they had in Italy or the villa that they had in France, and so they come forward to voluntarily report the existence of that asset. In many cases, there actually is no tax owing unless it's unreported income. So often, if you don't report the existence of a foreign asset, there usually isn't any tax that is owing if you're not earning income from that property. Let's say you have a vacation property that you rent out. If you're not reporting that income, then clearly you're going to have to pay tax on that income. But if you just own the vacation property and you never reported it, and it's your second or your third foreign property, then likely there is no income to be concerned about. But what there is are penalties, and if there is income, there's interest on that undeclared income that we have to be concerned about. So with the Voluntary Disclosure Program, it allows for no penalties, so that's significant because in some cases the penalties could be quite large, and a reduction in the amount of interest and in the number of years in which that interest is charged. So coming forward under voluntary disclosure is an opportunity to come clean and get an abatement of interest and no penalties being imposed. So it's a great opportunity for people to come clean on their taxes.
Okay, great. Thank you very much. So that concludes today's episode. We hope that you found that information very informative, as I did. Thank you again, Sabina.
Thank you.
It was a pleasure to have you on the show,
Thank
and
you very
hopefully
much.
you'll be back again. If you're in need of a tax lawyer, you need some tax advice, I strongly suggest that you get in touch with Sabina at Devery Smith Frank. And until next time, to your success.